So first off, I've been doing a series of these sort of more technical presentations. So in the future, they're going to start building on top of each other. Now, this is not the case for this one. You can watch this one without any prior knowledge, but you do need to understand what a candlestick and candlestick charts are. So if any of this is confusing to you, that's most likely where it is, and you should go back and watch Panos's video on our YouTube channel about candlestick charts. So we previously looked quite a bit about analyzing charts, and we've been talking about straight up technical analysis, which is where we take a look at the candlesticks, see what they're doing in relation to each other, look at various levels, and try to draw information out from that. So what's different between that and the technical indicator? Well, the difference essentially comes down to, with technical analysis, we're looking at the raw data, just those candlesticks that indicate price movement. Indicators build on that raw data and allow us to look at it in new ways, and then give us an indication, hence the name, about whether or not to buy or to sell. It's named that way because it's like a car indicator. You know, some car flicks their indicator on and says it's turning right. Everyone else on the road knows it's turning right. The same thing happens with stocks, in theory. And it comes back to herd psychology. Lots of people are looking at these indicators. So when they see one that everyone knows means a stock's going to go up, people buy it. And that, therefore, drives the price of the stock up. So it becomes a bit of a self-fulfilling prophecy. Now, does that mean that these indicators are 100% accurate all the time? If you've been paying attention to any of my previous presentations, you know exactly what I say here, and that is absolutely not. Nothing in the stock market or finance in general is ever 100%. All these indicators are another tool to help us decide when to buy or sell. So it's really important to remember that. Now, there's two main categories of technical indicators, and that is lagging and leading. The difference is basically that lagging is looking mostly at the past. So it's looking to confirm things that we already believe are happening based on past data. Leading is supposed to predict where things are going to go in the future. Now, we're going to talk a bit more about leading indicators in future weeks, but for the moment, we're going to focus on lagging indicators. Neither of them work better than the other, but they just complement each other and work in different areas in different ways. So, the simplest example of a lagging indicator, and realistically of all technical indicators in general, is what's known as the moving average. The moving average is based on a set number of periods in the past, taking the price action in that period and just averaging it out. So on the chart here, we've got a various number of moving averages, and these are these bold lines you can see going alongside the candlesticks. And it's one of the only technical indicators that is actually plotted on top of the candlesticks. Most other ones are separate because it's doing new things with the data. But this particular one, it's helpful to see it with the candlesticks. So if we take a look first at the 100-day moving average, it's bold now in gold. What this does is, at this point here, it takes the last 100 of these candles all the way back down somewhere over about here, I think, and it takes the average of all of them. And that's the value for it. The point before it, it takes the previous 100 candles and averages those, and so on and so forth. And that gives us this gradual line that follows the shape of the graph, but doesn't match it exactly. Now we can have different numbers of periods. So here we've got a 50-day moving average, and you can see because it's a more short-term average, it more closely follows the shape of that price action. And the same is true of the 20-day moving average. This one is even more short-term and even more closely follows the action. Now, I've been saying 100-day, 50-day, 20-day. These don't have to be daily averages. They could be on a 5-minute chart because each of these candlesticks can represent any length of time. So if you had a 5-minute candle, you could have a 5-minute moving average, or a 25-minute moving average, and a 105-minute moving average. Some of the most common ones are these ones shown here. Now, between moving averages, we've got two different components. We've got simple moving averages and exponential moving averages. I'm not going to go into the maths of how you calculate them. It's not that difficult, but most tools will do it for you automatically, and I don't want to bore you with a bunch of Wikipedia formulas just plastered on the screen. The main difference is that an exponential moving average applies more importance to more recent data. And it just does that by weighting the recent data in the average. That means it reacts more quickly to recent data than the other simple moving average. I'm going to say it as I always say, neither one is better than the other. They're just useful in different situations. So a swing trader, for example, might use an exponential moving average more often than a simple moving average because they want to react to more rapid price fluctuations. And when you're investing, maybe you'd be looking at a simple moving average more often. Now let's look at an example. Chris and I have talked before about Tesla. I always mention I want this Tesla Model S. It's a big shiny red car, and I see one of them on the road I walk past to my girlfriend's often, and it just looks so cool. Now these bad boys run for about $100,000 per. Let's say that last March I had $100,000 sitting in my bank account. I definitely didn't. I'm not that well off, but let's just pretend I did. Now I could just go to the Tesla dealership, fork out my 100K and walk away or drive away with a very nice looking electric car. But let's say I decided to be a bit smarter than that. And let's say I decided to try and invest my money, grow it, and then buy my car. Well, I could try to identify a trend on a stock to take advantage of. Now, if I'd looked at Tesla stock back last year at this time, 6th of April 2020, I could have seen, looking at the moving averages, that the stock price was just crossing over from under the 100-day moving average to over the 100-day moving average. This is a technical indicator that the stock price is starting to move in the upward direction. Now, the price there was about $100. So with my $100,000, I could buy 1,000 shares. And then I sit and wait, and I watch the stock for months on end. And what I'm watching for is the stock to cross the other way and come down below the 100-day moving average, because that to me would be an indicator that the strength of the stock was weakening, and so maybe I should sell. Now, if I'd been watching, this actually would have happened almost a year later, on the 4th of March, 2021. And the price here was about $650. Calculating that all out, I'd have walked away with about $500,000, and I would have been able to go away and buy 5 different Teslas for my garage. I don't even own a garage, so more likely I would have bought my one and walked away with $450,000 to invest somewhere else. So that's one use of moving averages, is how they interact with the stock price that they're calculated from. But that's not the only way that we can use them. We can also just analyze the indicators themselves. So these are showing what's known as the golden cross on the left and the death cross on the right. Now, the golden cross is when a short-term moving average moves above a longer-term moving average. In this case, we've got the 50-day moving average is crossing above the 200-day moving average. And that's seen as a positive or bullish indicator for the stock. So it's probably going to keep going up. It's showing that there's more momentum recently than there has been long term. Stock's probably going to keep going up. As you might guess, the death cross is a reverse. So that's where the shorter term moving average, this red one, has crossed below the longer term moving average, the blue one, and it's indicating that the recent action has been a lot more negative or bearish. And so that could be taken as an indicator to sell the stock, so you miss that, so you don't get hit by the big move downwards. Now, I want to go back to what I said at the start and reiterate, these are not 100% indicators. It's never a case of it's always correct. And to show this, here's that same stock chart of Facebook with another death cross here. If you'd sold out of this death cross, you'd have missed this whole move upwards here. And ended up, if you bought in at this golden cross here, you'd have sold out here for a big loss. So these indicators need to be used in conjunction with all the other tools we're starting to learn about the group in order to make profitable trades or investments. They can be quite useful for us as investors. I know we've been talking a lot with technical stuff about trading, but for us as investors, they can help us to start figuring out what time's the best time to buy a stock that we are already interested in holding for the long term to try to maximize our gains. But we're going to talk, that's a whole topic on its own, so we're going to talk about it in the future. On this, does anyone have any questions?
Hi there. Thank you so much for watching our video. I hope you really enjoyed it, and I hope you learned something. If you have any questions, please let us know in the comment box. And don't forget to like and subscribe so you can learn more about our channel. Thank you very much, and see you next time.